Equity Market Update, March 2021. FY21 was the best year in the last decade for the equity markets. After experiencing a sharp fall in March 2020 on back of COVID-19 related disruption and uncertainty, the equity market rebounded strongly in FY21 and not only covered the lost ground but scaled new all-time highs. The recovery was driven by large monetary and fiscal stimulus measures globally, high global and domestic liquidity, lower cost of capital, good recovery in economic activity, post-easing of lockdowns, lower than anticipated impact of COVID-19 on corporate earnings and economy, optimism on rollout of vaccines, etc. Indian equities had a stellar year with S&P BSE Sensex and Nifty 50 touching all-time high during the year and ended the year approximately 70% higher than last year, outperforming most of the developed and emerging markets' major equity indices. Further, after a few years of underperformance, the small cap and mid cap indices outperformed the large caps and ended the year with over 100% gain. Most of the key sector indices ended in strong gains, with metal, auto, IT and capital goods performing better than other sectoral indices, while oil and gas and FMCG underperformed. Globally, most major indices also ended the year with good gains, with key indices of Korea, Japan, US and Germany performing better than the rest. After witnessing one of the largest FPI outflows in March 2020, FPI flows returned with a vengeance and Indian equities witnessed the highest ever inflows in a financial year. Net FPI flows into equity rose to $37 billion in FY21 as against $1.3 billion in FY20. However, domestic equity-oriented mutual funds witnessed outflows of approximately INR 63,000 crore in FY21, vis-a-vis net inflows of approximately INR 67,000 crore during last year. Corporate earnings have been strong too, with impact on earnings significantly lower than earlier anticipated. Interestingly, Q2 and Q3 FY21 experienced one of the highest earnings growth in the past 5 years and resulted in broad-based earnings upgrade. The good growth in earnings was driven by pent-up demand, improvement in realization, cost control measures, fast recovery in economy, rise in commodity prices, etc. We expect that some of these factors are likely to sustain over the near to medium term. Further, budget with its focus on growth and capex revival augurs well for new investment cycle and corporate credit growth. Despite the impact in real economy because of COVID-19, rise in Nifty 50 in FY21 has been stellar and touched all-time highs, significantly higher than pre-COVID-19 highs. Interestingly, despite the sharp rise, Nifty 50 returns over the past 10 years and 15 years are approximately 10 to 11% CAGR, largely in line with nominal GDP growth. Again, while the rally has been sharp, it has been relatively polarized, with top 5 stocks accounting for a high proportion of returns till 2020. While improvement is visible in performance of broader market over the past few months, we believe there are select pockets which are still undervalued compared to their long-term averages. An interesting aspect of the market is the considerable divergence in valuations across sectors compared to their long-term averages. Outlook. As on 31st March 2021, Nifty 50 was trading near 21.9x FY22E and 18.5x FY23E price to earnings ratio. In our view, these are reasonable multiples, especially given the low interest rate environment and improving economic activity. Further, the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield stood at 1.6% below its 10-year average of 1.8%. Further, though Nifty 50 has risen significantly, one should be mindful that Nifty 50 returns over the past 10 years are essentially similar to growth in nominal GDP. In light of the above, in our opinion, markets hold promise over the medium to long term, and there is still good value in select pockets of the market. Good improvement in corporate profitability, lower cost of capital, comfortable external scenario, monetary and fiscal measures undertaken along with relatively better placed rural economy also supports this optimism. In view of the above, in our opinion, there is merit in increasing allocation to equities in a phased manner or in staying invested as the case may be, for those with a medium to long-term view and in line with individual risk appetite. Significant rise in spread of COVID-19, unwinding of expansionary fiscal and monetary stimulus, significant rise in crude oil prices, higher than expected NPAs post the moratorium, etc. are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.